Hi everybody, welcome to Point and Figure Charting to maximize your profits. Good to have everyone here. Thanks for coming in. I'm really pleased to be doing this. This is the first webinar I've done in quite some time, a couple of years anyway. So we've got a full house here and everything looks good. Let me just make sure the sound is okay. Just give me one more quick sound check as we go on here. Great. Okay. Perfect. What's happening here? Is it going up? Okay. All right, good. Okay, glad to finally learn point and figure chart. Yeah, this is an interesting thing. You know, point and figure charts are kind of difficult, and they're the oldest form of charting in the Western world. I suppose candlestick charts predate point and figure charts. But despite the fact that it's the oldest form of charting, there's very little about it out there. But I'll show you everything I've got on it as we start tonight. So let's just do the preliminaries here, as we always have to do in the United States. We're doing an educational program here. You're responsible for your own trading, which of course is a very risky thing to do. So you're always advised, strongly advised, to consult a financial advisor, a certified financial advisor, before making any investment or trading decisions. And of course, I'm not responsible for your trading, nor is my company, TradingPsychologyEdge.com, or anybody who is associated with it. So I think that's good enough for that. You can read that for more details. Also, please be aware that this is all copyrighted material. So please don't put it up on file sharing sites or send out the handouts to your friends and stuff. Family members, of course, are okay. But everything else, this is my intellectual property. So please respect that, and I appreciate that. Okay, so let's get into what we're going to cover here. And we're going to start off with the basics and quickly move into some incredibly good stuff, advanced stuff. But I'm going to take you through it step by step. And so we're going to start off just with constructing point and figure charts. It's really important that everybody understand how they're constructed and what they need, what they propose to represent. Then what I'm going to do tonight is I'm going to look at all of the fundamental and many of the advanced point and figure techniques through an in-depth analysis with Apple. And we're going to go back a couple of years and do exactly I thought about this very carefully. And, we could take snippets of this market and snippets of that market to highlight different principles. And that's certainly one way of doing it. And it's not necessarily a bad way of doing it. But I think a more organic and a more integrative way of learning this is to follow a stock for a period of time and see how the point and figure charting all plays out, and to see what we can learn from point and figure charting as that market unfolds. It's the way Wyckoff would do it, and I think it's a really good way of doing it. So that's the way I'm going to approach that tonight. Now, I suppose because it's the first webinar I've done in several years now, and because I really wanted to give you a full understanding, as full as I could, understanding of point and figure charting, I probably overdid it and gave too much information or put in too much information. I don't think that's a bad thing either. I think you're the beneficiaries of it. But it forces me to take what I thought would be a 2-hour presentation. We're going to be lucky to get through 2 hours tonight, in fact. So I'm going to split that up into 2 sessions. We're going to do Apple tonight with all the fundamental and several of the advanced point and figure techniques as we follow that through. And then next Tuesday at 5 o'clock, I know it says 4 o'clock on the slides that you've gotten, so that's an error. It is 5 o'clock, just like tonight. It's 5 o'clock. So 5 o'clock next week on, I think it's the 17th, Tuesday night. We're going to go over Bob Evans's count guide, and we'll look at 2 markets. We'll look at a futures market and we'll look at another stock in doing that. And the count guide will both answer lots of questions that you might have as we go along, and also give you a coherent way to utilize point and figure charting. So hopefully that will be of benefit for you. Okay, do me a favor. I'm sorry. I'm a little confused in my little box here where I see questions coming in. Just would some of you just type in anything? It doesn't matter. Just type in Y's or yeses or hellos or something. Okay. All right. Now I know. Okay, great. Thanks. Now I am oh, that's so funny. There are things that are jumping around here. Why is that happening? Hang on a second. I want to make sure that I've got this properly done. Okay, I think now I'm okay. All right, good. Okay, so that's what we're going to cover. And let's get into it now. We're going to start with constructing point and figure charts. So I've got a regular bar chart of Facebook. It doesn't matter what stock we pick, on the left-hand side of your screen. And we have a 1-point figure chart on the right side of the screen. Couple of things to notice here right off the bat. First off, point and figure charts are going to be more compressed, if I guess is the way to think about it, than the vertical line charts. So we call the daily bar chart or any bar chart a vertical line chart. So you might hear me refer to the vertical line chart. That's what this is, a standard bar chart. Okay? Point and figure charts, on the other hand, are going to compress the data. Why is that? Because they're only interested in price change and price movement. They're not interested in time. I don't have a slide for this, but we can see the market going sideways for what seems like forever, maybe a couple of years. And we might only get a little bit of back and forth on the point and figure chart. It might only be a couple of inches rather than, several yards, if you will, of price data. So that's the one thing to note, is that because we're only concerned with price change and recording price change, not time, the point and figure chart is compressed. Second thing to notice about point and figure charting, and this is going to be even more noticeable as we go along tonight, is that support and resistance become really obvious on a point and figure chart. You can see here along the 74 line, I'm going to start throwing out some terminology for you. The 74 line is this area here, and we can see that the market is holding in here. There's good support in here. That's very clear. The same area on the vertical line chart shows that certainly support is there, but it's a little less obvious. Okay, we come up here to this level, the 78 line, same kind of thing. It's a little less obvious on the vertical line chart, but on the point and figure chart, it's very obvious. Certain things that we've come to know and love in terms of old resistance becoming support show up on the point and figure charts very nicely as well. Along the 81 line, we can certainly see that resistance occurred back here a couple of times. And again, notice how the resistance here is a lot more clear than the resistance here, right, on the vertical line chart. And then as we come across later in the point and figure chart, we see 81 again holding now as support, resistance turning into support. Certainly we can see that on the vertical line chart too. It's just not as clear, okay? So there's a level of refinement that exists on the point and figure chart that we just don't get on the vertical line chart. Now, to be fair about it, the reason we're getting that refinement is because we're not interested in all of the small moves that we're going to see on the vertical line chart. I'm going to explain this in a moment, but we're only interested, it's a more gross or a more crude chart, if you will, where for example, down here, where the vertical line chart might be painting 77 and, 25, 77.25 or 77.30, something like that. On the point and figure chart, we don't get that refinement. We only get 78, okay? And I'll explain why that is the case in a moment. But just notice that is a little bit more crude, but that crudeness allows us to really identify support and resistance in a clear-cut manner, and that's a big plus, okay? Okay, now I'm hearing there's no audio. Is that fair for everybody, or are you able to hear me okay? It sounds okay. All right, good, great, thanks. Okay, just making sure. All right. The other thing that occurs that may not be so obvious is that congestions become more obvious. We can certainly see that we're congested in here, and we're congested in here, and we're congested in here. Okay, we can start to define the parameters or the limits of congestion very, very well. And just as well, just as easily as we see congestion, we also can see markups and markdowns. In this case, we only can see markups because the market is moving up. But these vertical lines here, these vertical moves, certainly we can see those on the vertical line chart too. We see it here and we see it here. But not necessarily that they become more clear on the point and figure chart, but they exist very nicely. And so we will see, as I explained about, in this case, we're using a 1-point figure chart, which means that the market has to paint a new figure from an X to an O, an X being up and a 0 or an O being down. There has to be at least a point of movement in price to paint that next lower 0. So when we see a markup on the point and figure chart like this, we know that there's been no retracement back by that made, that was a point or greater, right? And that's for a 1-point figure chart. If we were using a 3-point figure chart, then we would know that, and we saw something like this, we know that during that run up, there's been no 3-point moves, no 3-point pullbacks. That's pretty valuable information. I mean, this shows a very strong market, right? When we have these movements up and we don't even get a 1-point retracement until here, or here, right? So those are some things to note about the point and figure chart and how we want to start to try to approach them. Support and resistance, very obvious. Congestions and markup, very obvious. And we compress the data so that we're not looking at every wiggle and waggle, so to speak. All right? Okay. So let's see how they're constructed, because this is really important. All right. Um, and maybe this is the most difficult part of this presentation, in fact, is to explain how they're constructed. The first thing to note is that not every price bar produces a figure on the point and figure chart. These X's and O's, these are figures, okay? So let's just get into it. It's probably the easiest way to explain this. So we're using a 1-point figure chart, which is very common in stocks. And unless you're trading a stock that's, I don't know, a couple of $100 or more, something like, I don't know, like what's a high price stock these days? Google's still a high price stock. You know, you'd probably want to use PCLN. What is that? I forget what that is. That's a high price stock. So you would want to use something bigger than a 1-point. But for the vast majority, and we'll talk a little bit about different sizes, box sizes and reversal sizes in point and figure charting in a moment. It's less important than you might think. For the moment, let's just stick with a 1-point, which means that each figure, whether it's an X or an O, represents 1 point. Okay? Sometimes you'll see it talked about as box size, BOX, box size. But that's really, it's really 1 point is what the figure chart is. So a 1-point by 1-point figure chart, a 1-point box size with a 1-point reversal, which is the standard Wyckoff point and figure chart for, well, it's the standard Wyckoff point and figure chart, stocks and otherwise. So each figure represents a point, and each reversal requires 1 point to get the figures to start to head in the other direction. Okay, so right here we're at 86 and change. We'll coordinate this in a moment. We could be going 86 and change for a while, but until we see 85 or less, we do not paint or do not put in that 0, that O figure. We don't go down until we have at least a full point of price movement to the downside. And we keep going down until we have at least a full movement of price to the upside. And then down and then up, okay? So we'll just talk a little bit about size, point and figure size. I mean, that's the basics of the 1 point. But if we were, so we're trading Facebook here, or we're looking at Facebook, and Facebook is in the 80s, and so a 1-by-1 figure point and figure chart or a 1-point figure chart is fine for this. If we were trading or charting, for example, the S&P E-mini, that's in the 2000s now, right? So if we were looking for larger swings on the S&Ps, we might be using a, I don't know, 15-point, right? If we were trading the S&Ps on an intraday basis, that might be different. The larger swings, we might be looking at a 15-point figure chart. On the intraday, we might jump back down to a 1-by-1 point, okay? So the point I'm trying to make here is that the size of the figure chart is going to be a little bit dependent on what you want out of trading. If you're swing trading stocks, a 1-point figure chart is great. If you're swing trading the S&Ps, then I would suggest a 15-point, or maybe you could drop down to a 5-point if you want to. If you're looking at major swings in the S&Ps, somewhere between a 50 and 100-point might be good. If you're looking at major swings in Facebook that's trading around in the 80s, at least on this chart, you might be looking at a 3-point figure chart. Okay, they're going to be different depending on the application that you want to make, and also to some degree dependent on the price value of the instrument that you're trading. If we were trading oil, we might be on a 50 cent or maybe even 25 cent figure. Well, we might be doing a 1-point figure chart for oil in general for larger swings. If we were swing trading that, meaning that we're holding the trade for, I don't know, 3 days to maybe a month or two. If we were intraday trading Facebook, we might use a 10 or a 20 cent point and figure chart. If we were swing trading oil, we might use a 50 cent. And what I would suggest to you is that look at your markets and try different point and figure chart sizes to see how they correspond with your trading. And you can also, I don't want to get into it tonight about what should, if I'm trading cocoa, what should the point and figure chart be, or if I'm trading gold, what should it be? You can ask me that question. At the end, I'm going to suggest that any questions that you've got, send them to me like that in an email, and then we'll address them next week. Get them to me by let's see, we're going to meet on Tuesday. So get them to me no later than noon on Sunday next week, because I'll put whatever I'm going to do together probably Sunday afternoon into early evening. So if you get them to me by noon on Sunday, I'll be sure to have time to be able to answer them. But questions like that, do an email. Questions that come up as we're going along here that you don't understand, or you got a question about, just don't hesitate to ask, and we'll answer all questions here, okay? So it would be 15 by 50 in the S&Ps? Not necessarily. It probably would be 5 by 3. A 5-point box size with a 3-point reversal will give us a 15-point figure chart for the S&Ps. That's one that I like a lot. But we're going to go into more on constructing them in a minute. Let's focus on how to just take them raw and put them together. So here we have a rally, and we go up to, at A, we go up to 1837, okay? And we can see that rally that started down here at on the point and figure chart at 70 on the 74 line, and we go up and we come to 81, all right? Now, even though we get 81 and 37, this 37 doesn't mean anything to the point and figure chart. We ignore that. It's only when we get to 82 or more, 82.37, that we can put an X or put a figure on the 82 line. But we don't get there. We get to 81.37, but that's not enough for a figure on the 82 line. The market falls down to 78.52. Just follow me now with this, okay? Well, 78.52, you might be saying, yeah, well, 52 is more than half, so shouldn't that be 78? Well, no, it only goes to 79 because we didn't go the full amount down to 78. You see, point and figure charts are only interested in price change against the figures of the or the structure of the point and figure chart. They don't care about anything else. Okay, so then we rally up to C. Look at what happens at C. 81.99. Isn't that good enough for 82? Not according to the point and figure chart, folks. That only goes to 81. Okay, only goes to 81. Doesn't matter that it's 81.99. We come back down to 77.26 on the vertical line chart at D. Well, that's again down to 78. Okay, so you get the idea. We go up to 79.38. That brings us up to 79, period. We don't have enough to get to 80. Even though we go over 79, it's not enough to get to 80, so we don't count it that way. We only count it to 79. Now, the other thing to note about the way we do point and figure charts is that we go up here, we go to A, which is here, and now we start to fall to B. That's fine. Okay, we can see how that That works. We get a full figure at 80, and then one at 79. So we put those two zeros in. Now the market starts to rally up to 81.99 at C. So we go back up one full. We've rallied one full point up. So we put it in at 80. We start a new column up on 80, and then 81. We don't get to 82. Now the market starts falling. Well, we are going to reverse now. We're reversing, and we need to have one full figure in order to reverse and create a new column. And that's what happens at 80, and we'll go down to 79 and then 78. Okay. Now, this doesn't go sideways at 78 here. We're not doing that. That's not the case at all. What happens here is that we rally up to E, and we put in, it's a change in direction, so we put in a new column because we are going up, and then we come down. Okay, we go up to E, 79, and then down to F, back to 77. So we come back down to 77. Okay, and if we were to go to 76, we would put another 0 in here, and if we were to go down to 75, another 0. But we don't do that. We go up to 78, and that starts a new column. I'm sorry, 79, and that starts a new column. We go all the way up to 86, and we go straight up. If there were pullbacks in here, there's one in here, right here. It's not a full point pullback, so we ignore it. We ignore that data. Okay, and then we start coming down and so on. All right, a few questions here. Could we use a certain percentage of average daily range as the box size for this chart? Well, maybe, but David, I've never seen that happen or seen that done, so I wouldn't know how to do that. Okay, try to keep it simple and try not to complicate things. We want to keep things as simple as possible, because if you're using, for example, just off the top of my head, the problems that you could create with doing an average daily range as the box size is that average daily range is a measure of volatility, right? Volatility is highly cyclical. There are times in the trough of volatility where the average daily range is narrow, and then there are times when it expands that the average daily range starts to expand as well. So if you're tagging your box size or your reversal size to average daily ranges, you're gonna probably, I'd have to think this through, but you're probably going to underrepresent the market when the volatility is low and the daily ranges are small, and you're going to overrepresent the market when the volatility picks up. So just off the top of my head, I would say that's not a good idea. Just stick with simple simple approach. Some columns have X's and some columns have O's. Why? They don't have to. I'll show you in a minute my hand charts. I can jump up to those now. And you can see that they're all dots. There are O's in here at 30, for example, and there are 5s at 25. It's just a convenient way to mark those on the point and figure chart, nothing more, but you can just use solid dots. It's not a problem. Is it on a closing basis? Well, that's another area of variability. No, we would use it on the range. It's the high or low of the bar. Not everybody does it this way. David, for example, will use a close rather than the high-low range. This is one of the areas where I would respectfully disagree with him. I had extensive discussions with Craig Schroeder When he was alive, he was the head of Wyckoff Stock Market Institute up until a few years ago when he died. But I had a lot of conversations with him about point and figure charting and how to do it. And I think that at least the way I do it is consistent with what SMI was doing at the time, which was what they've been doing since, I don't know, the 1930s. So, are you rounding off to the nearest high or low? You do, no, not, you don't round off to the nearest high or low. It's only, Dan, if price penetrates your figure. If your figure is 81, right, price has to penetrate it or touch it, has to either touch or penetrate it for a figure to be recorded. If it goes a little higher and we're at 82, we don't penetrate or touch it. You can see even at 81.99, we're not touching it. And at C, it's only shown as 81. Where are you pulling these together? Every day, every 2 days, every 3 days? Every day. If I were doing it by hand, I would do it every night. So there's never any sideways movement with point and figure? Sure there is. Sure there's sideways movement. Well, no, you're right. If we were stuck in this, I don't, 74, boom, boom. So you can see here on the 76 level, there's 1, 2, 3, 4, 5 days of sideways movement. Look at here. This is that area on the point and figure chart. We can go 90 days. As long as we don't hit 77 or 75, we can have 90 days of going, or a million days of going sideways at 76. From 76.99 to, what is that, 75.01. And as long as we don't hit either 75 or 77, that's it. And there's no more figures that are counted on the point and figure chart. Good question. On stockcharts.com, their point and figure charts can use an average true range. Steve, there are lots and lots of different ways of doing point and figure charts. I'm showing you the Wyckoff method. That's the only method I know. I don't know about average true range methods. To me, it sounds very complicated. If it's complicated, I don't want to do it because complicated things introduce complexity. And I have found over the years that trading as simply as possible is the best way. And in any event, it doesn't comport to S&P to the Wyckoff method. Why isn't F a new column? Why isn't F a new column? So we come down to D, we go up to E, we come down to F. Well, because because there's a space down below, we can continue to go down here as long as, so let's say we go to 76 on F, right? Let's say F extends itself to 76. If I need to see your name here. I guess it's Vince and Stephen. You have the same questions. Okay. So now if Vince and Stephen, we come to 75, then we're going to paint another 0 down here. However, if the market starts to rally and we go to 77, then we start a new column. Okay, we go up here. All right? And up to 78. So that's why. If there's space, we don't. And if it starts if the price change starts a new direction, then we create a new column there. Am I always using highs, lows versus closes? Yes, I do. 77.26 marks at 78 and not 77. 76.26. I'm not even sure where that is. 76.26. 76.26 would be at 78, right? Because it doesn't go down and touch 77. So it would just stay at 78, and that's what is shown here at D. It's on 7. It's the point and figure is at 78. Okay. We talked about stock charts and ATR. Can it help to use volume histogram at the bottom? Yes, it can. I'm not going to talk about that because that's a different kind of chart. But it can. If you have, for example, you'll have strong volume on markups, and then what you're looking for is less volume on reactions like this, right? And then strong volume on markups, and then less volume on reactions. But what I wanted to do is give you the fundamentals of point and figure charting. That's a little bit more advanced topic. And I don't use volume in that way on point and figure charts. I would prefer to use the Weiss wave volume in combination with the point and figure charts. I think that gives you a better read on the market. But again, that's like a whole new webinar there. Okay, what determines if you start a new column or row? Well, I went through that, I think. Good artists borrow, great artists steal. Yes, they probably do. Why wasn't a new column at F? We talked about that. What if you achieve a large bar that encompasses the previous bar? Then, I don't know, do we have one of those? Well, you sort of have that here, and you just mark the figures. That's all. It's doesn't matter if there's enough. Let's see if we can kind of scope this out. Here's one. Here's one, a large bar that encompasses the prior bars, 2 bars. The prior 2 bars were at 76 and 77. So 76 and 77, is that right? And then this bar, I don't have the figures, it goes down to 74 and maybe up to 78. So this bar goes down to 74, but it looks like it didn't go to 78. I'm sorry. Goes down to 70. Hang on a second. I have to see how this works. So we're down here. We're up here. 76 and 77. 76. And then 77. Actually, this goes up, right? We're this bar, we'll call this bar 1 and we'll call this bar 2. So bar 1 is here, and then bar 2 is this X because we go up. We've made a new figure. We've made a new figure to the upside. Okay. Now what happens is the market goes down and then up. So we're at X. We can come down to 74. And now up to 78. Okay? See how that works? We start here, we go up, we go down, we go up. So we start here, we go up, we go down, we go up. So that's an example of an outside bar encompassing a couple of bars. Hopefully that makes sense. Okay. Don't think you could overlay volume on point figure with TradeStation. I'm not sure about that, truthfully. So at M, price went down 1 point, but then went up, making O in the same column, right? At M, it went down to N. M, up, down, up, down, up, down, up to M, down to N, and then up to O. That's right. So it's up to N, down to N, and up to O. Up to N, down to N, up to O. Up to N, up to M, down to N, up to O. So that's right. Would this account for all volume traded if used with a point and figure chart? I think so, yeah. I think the questioner is asking why is there an X and an O in the same column at E and F. At E and F. Because, look, we come up here. Let me just, and then I want to move on, because we're on I've got 70 charts and we are now 40 minutes into this, and I'm nervous that we're going to go forever on this. Okay, so we rally up, we come down, and paint a 0. We rally up to A. That's X's. We go straight up. We come down. We've changed direction. We paint a 0. We rally up to C. We go up to C. We come down to D. We go up to E. Come back, do a little test at F. Come back at F. And then start going up. If we're at F, we had gone up to E and down to F, up to E, down to F. On the point and figure chart, so then we start moving up on the vertical line chart. If we tried to go up in the same column on the point and figure chart, we run into the X at E. We have to go over and up, okay? We have to go over and up. It's the same thing starting at C. We were at B, we were at B and we come up to C. We're at B, we have to go, if we were going to go up, we would run into the 0 at B. So we have to start a new column. We go up to C. Same thing, we start to come down after C. If we start to go down, we're going to run into that X. And so we have to start a new column. Go through this and work this out. It's not easy to understand. I realize that, but we can't spend the whole bloody 3 hours talking about, how to construct the point and figure charts. If it's not clear, I can probably send some material from the Wyckoff course that details it. I mean, I'm trying to explain it as clearly as I can. I thought it was pretty clear. Okay, yeah, I've explained it well. Okay, best thing to do is to try it on your own and compare it for a real point and figure. Yeah, that's right. Okay, it is clear. Okay, so let's move on. Thanks. Let's move on. Okay, so how do you can draw them by hand. It's a useful thing to do, to put these together by hand, because there's something about using your hand and recording things. You're going to remember it better. You're going to see more things. I used to do this up until a couple of years ago when TradeStation finally got Wyckoff type charting working. They didn't before. And we used to use something called Bullseye Broker, which was a charting package that was the only one that I knew at the time that would do Wyckoff. It was fine if you use just end-of-day data, but as I'll explain in a moment, it's not a good idea just to do that. And so any intraday data was always sort of sketchy in that software. So I found just doing them by hand was the best. So this is an example of Merck, a 1-point figure chart. Here's an example of the S&P cash market, 15-point figure chart. Where each of the boxes are 5 points, but the reversal takes 3, so that's worth 15. Now the problem with hand charts, of course, is that it's easy to make errors, and so you're erasing and rewriting and all of that. It's tedious work. There's no question about it. Now a lot of programs can do point and figure charts. And so, for example, my software, now I don't know other softwares. I'm not in the business of advising people on software. I use TradeStation. I've been using it for a long time. I really don't know other platforms out there. I really can't tell you what to do, what not to do. This works for me. Okay, I don't get any money or have any affiliated agreement with TradeStation. This is just what I've been using for an awfully long time, and it works. So if you want to set it up in TradeStation, you can go to formatting your data, formatting your symbol, okay? And you go to the Settings tab, and you'll see your symbol. In this case, it's Apple. And you would put it on point and figure charts. There's all kinds of stuff, a lot of stuff I don't understand. But point and figure charts, and then that will open up the point and figure criteria for you. So box sizes, you can make these any way you want, but as we talked about, a 1-point figure chart is nothing more than a 1-point figure or box, and it takes 1 point, a full point, to reverse it. Now, I use a 60-minute, excuse me a second. Go. I use a 60-minute time interval. I used to use 15 when I hand charted, but 60 is fine. It's more than adequate. And I use the high, low, and range. You can use closed. Try it yourself and see how it works. But my discussions with Craig Schroeder led me to this conclusion, that a 60, especially for stocks, a 60-minute chart, high, low, and range is the way I like to do it. And in TradeStation, you want to enable one-step back column building. That's traditional or Wyckoff method. Okay, so that's the TradeStation software for what it's worth. So this is what the correct settings would look like when you do it properly. This is what a point and figure chart will look like. If you don't have one column building, this is what you get. And I have no idea how to interpret any of this. I'm sure some people do. There are probably books about how to do this, but it's not me. I just don't know how to do that. The other thing I would say is that somebody had sent me an email and asked me to look at this the other day, which I did. This is stockcharts.com. They have traditional point and figure charting, which is the Wyckoff method. They call it scale factor, box size, point size. I mean, you can go nuts trying to figure out all the different ways to describe this, but that's what this is. This is your point size, and then this is your reversal. So you can set these. Now, the only problem I saw is that this is on the freebie. I'm assuming that if you subscribe to them and pay them some sort of fee, you can get intraday data. But I can tell you that just using daily data is not going to be good enough, because you're not going to pick up the intraday distribution and accumulation that occurs within the daily chart. You're just not going to pick it up on a daily, if you're forming your point and figure charts off of a daily basis. That you need to use at least a 60-minute chart, okay? Some sort of intraday chart. All right, bunch of questions here. Won't our software do it for us? Yes, your software will do it for you. Most point and figures automate point and figure. Most chart platforms automate point and figures. There are methods of drawing point and figure charts where the X and the O are always in different columns. Maybe this is why there's some confusion. Well, I'm sure there are, but as I said, I don't know how to read those, so I can't really comment on those. Paid members can get intraday point and figures. Okay, great, thanks. That's good to know. So if you do subscribe to this, this will work for you. And they do produce. I've used their stuff in the past, and I think now that you say that, I used to use their intraday, but I still did it by hand. I like doing it by hand better, truthfully. And if you're just swing trading a dozen stocks or 20 stocks, it's really nothing to put point and figure charting together every night. Or if you're only looking at 5 or 6 or 7 futures markets, same thing. It's really easy to do the point and figures. on your own by hand. All right, so that's the basics, okay? And any questions in that regard, email me and I'll do my best to help you out on it. Okay, so is 240-minute data okay? You'd have to try that out. I think 60 is still better. When I used to track the S&Ps by hand, I used to track every 5-point swing, and so I was basically working off of there was no time, but it was kind of equivalent to a 5 or a 15-minute chart. The tighter you can get in your intraday, the better your point and figure charts in general are going to be. That being said, there's a limit as to what how deep we need to go, and my discussions with Craig when he was alive suggested that the 60-minute chart is a very good cutoff for yourself. Okay, Asta, come on, pup. Okay, so let's get into some in-depth analysis on point and figure charts. So point and figure charts predated Wyckoff. Wyckoff came to Wall Street in the late 1800s, 1888 or 1889, I forget what date it was, maybe the 1890s, sometime around there. But the first thing that he learned about charting wasn't vertical line charts. In fact, that hadn't been discovered yet, or wasn't popular yet. Point and figure chart he was basically a point and figure charting kind of guy to begin with. So point and figure charts come into play, I guess, in the mid 1800s. I don't know if anybody knows a more accurate date than that, but I'm guessing around the mid 1800s. So what I decided to do was to take a look at Apple from a point and view perspective, and we're going to only look at that. We're not going to coordinate vertical line charts at all tonight. We'll do that next time. But basically, I wanted to take the oldest form of charting here in the West, and I know candlesticks go back into the 1600s, but we're only talking about the West, and see how they apply to one of the most modern of stocks. You'd have to say Apple's on the cutting edge, right, of technology and all that. I'm sure we can debate the fine points of it, but in general, certainly during this period from 2013 to this past summer, they've been on the cutting edge. So we're going to take a look at Apple for the last couple of years, plus this decline. We're going to from the low here at A up to the high made at B earlier this year, and then the downdraft in August, and we'll end there. Okay, we'll see the August lows, and we'll see how the point and figure charts that were developed sometime in the mid 1800s, see how they work on this technologically sophisticated stock called Apple. All right. Now, we're going to just go through Apple tonight. I've got 6 parts of it. We've got 73 slides altogether, so 15 less 73, there's a good 55 slides on Apple. And we're going to cover all the fundamental and several of the more advanced techniques on point and figure charting and how to interpret it. Okay. And let me just say this up front. These techniques, the same exact techniques that we're going to talk about on a 1-point figure chart in Apple, will apply to a intraday chart in the S&Ps or oil or gold or one of the currency markets, whatever you're trading. Okay. All right. So we're going to use a 1-point figure chart, and we're just going to. It's a 1-point box size with a 1-point reversal. It's a 1-point, very simple. And we're going to start out without considering anything prior to 2013. In other words, I don't care what went on before that. We're just going to look at what is on the chart before us. Okay? All right. So we see that the market starts off on the left edge and rallies up to A. But then it immediately falls 9 points to B. Okay, we can count these. I'm not going to do this every time. I'll do this now. 1, 2, 3, 4, 5, 6, 7, 8, 9 points down to B. Okay. Now it rallies up 3 points, 1, 2, 3 to C, and it gets checked in this congestion here, in this resistance. All right, we rally up to C, and then we get checked in here. Now, one of the first main principles, a normal rally or a normal pullback would be to what Wyckoff called the halfway point. And he used halfway points extensively. And in point and figure charting, they're really, really useful. So a normal recovery after a 9-point fall would be between 4 and 5 points. Everybody with me on this? Give me a Y or a yes. I want to make sure I'm not losing anybody. Okay, good. Okay, so a normal recovery would be about 4 or 5 points. This one only goes 3 points. So what do you think that suggests? Yeah, weakness, right? It suggests weakness. So right there, you've got an excellent principle to, you can not necessarily hang your hat on and use it as a be-all and end-all, but it's one of the things in point and figure charting that's easy to see, easy to calculate, and we can always track those. Are we reaching the halfway point? Well, that's normal, so the market would still be weak. If it's less than, it's even weaker than you would expect. And if it starts to push above, then it's starting to show some strength. Okay? So this one only goes 3 points, and so it confirms to us that there's weakness in here. You can, start to take a position here then, just based on that idea alone, as the market starts to turn down. Of course, we would use other things like what's the price action look like, and you can kind of see that we have some pretty nice moves down here from A and down to B, and we're not getting any real rally up in here. It's just going sideways, and then we get, there's just no ability to rally, and then we get another nice move down, that nice marking down. So the market falls swiftly to D. And this one's 10 points. You can count them yourself. Okay. Now notice that this move is swift and fairly perpendicular. So it sets up an oversold condition, right? There's no mathematical number about how many points it is to create an oversold. It's more by look and feel. But you can see that we sell off sharply and come down 10 points. That's a pretty good move. In a stock that's around 70, 75 and it goes down 10, it's more than 10% drop. That's a pretty good move, okay? And it would be oversold. So the market then starts to go sideways to work off that oversold condition, all right? When working, would you make a line for the halfway mark? Yeah, you can, sure. You can do that. Absolutely. You can put a line in there and say, here's the halfway point. And you can see that it doesn't come up there. Sure, you can mark it up that way. Okay, so at E, now you got to imagine that we haven't painted this yet, right? We haven't put these figures in yet. So at E, the market's gone sideways sufficiently long enough to establish a count of 6 points. 1, 2, 3, 4, 5, and 6, back to here, all right? At C, does X represent an upthrust? It could, but that's more on a vertical line chart. You'd have to look at that. I don't really know. Are the deep retracements a sign of reversal? We're going to get to reversals in a minute. Kind of let me kind of spin this out for you, and I think you'll start to see it. So the only way a sideways movement can occur on a 1-by-1 figure chart is the price moves up or down a full point and then reverses by a point and so on. Yeah, so it's, it comes down to D, whatever that level is, goes up 3 points, comes down 2 points, goes up 3 points, comes down a point. And at this point, we've got 6 figures across that E level. All right. And we can look at that and we can kind of draw a little box in. This is the traditional way to do that. Box it in. And this gives us a projection as to how high the market might rally. Okay. So we've gone sideways. We come down. There's kind of a test of this level. And we can count across it, and we can go from the low. We want to be conservative. That's going to be one of the key things that we talk about in this. It's going to be a protective mechanism for you as a trader. We want to be conservative, so we start at the low. We can also start at E, and add the line of 6. So there's 6 here, and the low at D. I don't know what that low is. Somewhere around. Just get the concept here, and we'll get into this more clearly. But let's say it's 63, so we would add 6 to 63, and that brings us up to 69, and that's roughly where the market goes. In fact, it's exactly where the market goes. Okay, so this is how we start to project, and this will become more clear as we go on. I just want to get the concept down that we use these horizontal formations to make projections on how the market might rally, okay, or react. So we mark this conservatively from the low at D. We can also do it from E, but it's better to start at least conservatively and do it from the low point. And so the market rallies up 6 points to F. All right. So a couple of things to notice here. 6 points is greater than the halfway point, right? The halfway point from C to D is 5 points. We said this fell 10 points, right? So we're 1 point above the halfway point. So this is a first minor, let me emphasize the word minor, the first minor indication that buyers are becoming interested in this market, right? It's just an indication. It doesn't mean that we jump into the market or anything else. It's something we notice, okay? And we also see that this rally is checked at resistance at B. I'll put a line in there. Remember I said that point and figure charts, the support and resistance really jump out at you? And look at there, how nicely it jumps out at you. So we would know this all in advance, even though this is a static chart used for teaching. If we were trading this and we were skilled at point and figure charting, we would say, okay, we've got a line of 6 across E, and we've got resistance at B, which is also 6 points at B, which is also 6 points up at F. So we might be thinking this might be a good spot to consider a short trade. Because why? Because we're at resistance, and we've exhausted whatever buying, we call it a cause, the accumulation in this area that's been created, whatever accumulation that's occurred, we can count it, and that will be exhausted at this point. So this would be potentially a good spot to go short, okay? And we can also put in a trend line from A to C, and it intersects with F. So now suddenly, from a chart that looked like a bunch of gibberish a moment ago, we've got some pretty strong several indications here that, well, let's go through them. We're in a downtrend, right? We're making lower highs from A to C and lower lows from B to D. The rally exhausts its count of 6 points. We talked about that. That's the point and figure chart objective, and it's done. It's checked at resistance. Old support turns into resistance here. It meets resistance at the supply line. This red line is the supply line, the trend line. And it meets the halfway point, slightly above, but it's in the vicinity of the halfway point. So this is a great location for a short trade in Apple. Everybody see that? Okay. All right. How do we know it will rally? Well, we don't know it'll rally. We're looking, it's going sideways here for a bit, and if it does rally, this is the extent that it should go to, and then we can make a trade to the short side. We certainly wouldn't want to be buying this unless you're scalping. If you're trading this stock on an intraday basis, you might notice that this market there's some bullish tone to it, that it's not going down, that this level here, this 60, what do we say this was, 63 level or 65 level is a level of support, seeming support. We see that the lows are rising in here over the last few figures. So we would say that these supports are rising. So there's a bullish tone to it, an immediate bullish tone. We come down to E, and that looks like a test here. But overall, this market is in a downtrend, so we wouldn't want to overstay our position if that's the case. But that's how we would think about it, okay? That's how we would think about it. Is there a special meaning to the fact that there are 6 across? Not that I know of. It could be, we'll see stuff where we're going to see 10 across and 25 and 33 across. No special meaning about that. Does it also give suggestion about a stop? Well, your stop would be, it depends on how if you're, let's say the real play here is to go short, so your stop wants to be above the halfway point, right? If the halfway point is 5 and this gets to 6, so you could have a fairly tight stop in here, maybe 3/4 of a point to a full point. Okay. Yeah, Sharif says a confluence of lines. Steve says, oh, this is good. Good. Is that F a 45-degree angle? Probably. Looks like it. I mean, the way to figure that out is just to draw, to a vertical line and a horizontal line and see if that is basically 45, and it looks pretty close. Maybe not quite as steep as a 45. All right. So now we move down. So I've cleaned this up a little bit here, this chart, and the market falls to G. What do you notice now at G? What might be jumping out at you as the market hits G and then starts to go sideways in here, like in here? Yeah, shortening of the thrusts, right? Absolutely. Well, new low, right. Vince says new low. Good observation. We do put in a new low. But look, Vince and others, we're not making as much progress down here at as we did, say, from B to D. Right? From B to D, we can count this and we can say 1, 2, 3, 4, 5, 6, 7. It's very simple stuff, right? We've got 7 points here. Right? That was the move. That was the progress of the market from this low at B to this low at D. Well, from D to G, what happens? 1, 2, 3. Ooh, only 3 points. These are thrusts down, right? And so we would say that the thrust is shortening. We call this shortening of the thrust. And it comes up crystal clear on a point and figure chart. Everybody see that? Now again, this isn't telling us, oh, we got to jump in and mortgage the house and go long. We're noting things here, that buyers are starting to step into the market. Victor says, so you can use shortening of the thrust on point and figures. It seems like it would make it easier to not worry about missing out on a move by looking at it. Yeah, you can use shortening of the thrust, and you're going to see how I pull all of this together in a moment or two. Okay. So it's not something to jump in and buy into the market. I mean, if you're day trading, you might notice that and say, oh, it's not making as much progress, then I'm going to try a, or if you're doing a quick swing trade, you might, and you're happy to reverse in a downtrend, you could say, okay, I'm going to do something here, go long or whatever. Now, the same situation that we had at E comes up at H. Okay. Here we have remember, these haven't occurred yet. All right. None of this has occurred. So at H, we have a count of 5 across whatever line this is. And we go from the low of G to, and we count, when we project that count up by 5. And this will become so much more interesting and so much more clear in a few moments. But what happens here? What happens at H? We exceed the count, and that indicates bullishness as well. Also, we've exceeded the halfway point, haven't we? Right? The halfway point here should be around 4 to 5 points, and we go up 7 points. Okay, it should be here, and it goes up, or even here, and it goes up 7 points. Halfway point being the difference between, the halfway point between F and G would be roughly in here, and we exceed that, and we exceed the count. Okay, and we've broken the trend line. If we extended this down, it's obvious that we break the line from A, C, and F. And we have shortening of the thrust. So we see signs that the market's starting to turn, right? Everybody see this. Everybody see this. It's important. Yeah, and we broke the supply line, says Dean. That's right. You count up and add 1. I'm just 1. You got 1, 2, 3, 4, 5. So we start here 1, 2, 3, 4, 5. That's how you count it. Okay. And this little figure here shows where you start the count and where you end the count. That little graphic. Okay. All right. So now we're starting to notice that the market's beginning to build some strength in here. And these are the kinds of things that that we now want to begin to think about maybe a turn. Now notice the turn doesn't occur. We go April, May, June, July, and August, July here. I mean, it doesn't occur for some months, right? So it's one of the things I like about point and figure charting is that it gives you some pretty good indications way ahead of time. Much better than a vertical line chart will do. And you can, if you're short in this, and let's say you were short from way up in here, because this was a pretty good down move, I think. Maybe the count still had something to go, to a lower point from up above. I don't know. As I said, we only are looking from 2013 on. But it gives you plenty of time to start thinking about getting out and start watching Apple for a reason to go long, okay? But we wouldn't go long in here because there's no big count yet. There's no cause built, all right? Plus, we get a swift move down to J, excuse me. We get a pretty swift move down to J, and we start to, so supply, even though we started seeing shortening of the thrust and all of that, this is telling us, this move to J, from I to J, is telling us that there is still supply present, okay? So, if we back up just a second here, the support along G, we might be thinking, oh, there's, something good coming up here, but it can't rally up. It goes up and then starts coming back down immediately. So it's telling you kind of in advance that it wants to go down lower. And it does. So can we use reverse use of trend lines? Yeah, of course. So one thing we can notice too, though, that the declines here to G and J aren't able to meet the bottom of the trend channel. Right? We're not going all the way down. We should see something like this. If this was an intact trend, we would not see this, and we would not see this. We would see this coming down lower. Okay? So we can use the reverse use of trend line, what we call reverse use of trend line. It's just a technical term. You can just, in other words, you can draw a trend line. We usually draw, in a downtrend, we draw the trend channel from the highs, from A and C, and then or F, and then we create a parallel and run it off of the low. Well, we can also do the reverse of that when the market isn't coming all the way down, so we can make a trend line off of the lows rather than the highs, and that's called a reverse use of trend line. So we can draw that from D and G when we notice that G is not coming all the way down, and we have, some indications that buying is starting to come into the market, and we can start to target in here this area of J as a potential spot that the market might stop. Okay. So let's see. Let me clean this up. So now the market indeed holds around the lows at J, and we get a strong rally up to K. And it's checked at I. The supply comes in where we had supply come in before, in that same general area, right? And we note that the rally here from J to K is 10 points off the lows of J. So let's take a look at the rallies from before and compare this. If we look at the rally from B to C, we note that that's 3 points. From D to F, that's 6 points. From G to I, it's 7 points. And now from J to K, it's 10 points. So what does this say about the market? It says that buyers are becoming more assertive, right? However, there's always a however in trading. This 6-point move, this swift move down to L, is a little bit more than halfway back from J to K, right? The halfway point would be up in here somewhere. But we come deeper than that. And more so the swiftness than the halfway point, but certainly both play into it. And that says that supply is still present in this market. And you would think that that would be true, right? We've been coming down since the beginning. Now we're in May, so we've been coming down for 5 months. Markets don't turn on a dime. So this should not be a surprise to us. But it tells us that, yeah, we're getting buying coming into this market. The rallies are starting to get larger. We're not going all the way down to the demand line. And that's an indication of shortening of the thrust. We're breaking the supply line and so on and so forth. But there's still supply that exists in the market because markets don't turn on a dime. One of the things that the point and figure chart do is they help you be patient because we're waiting for certain indications to come up, and you'll see them as we go a little deeper into this. We want to count. There's no real good count here yet, okay? But notice that the low here gets checked at G, the same level here where buying came in back here, okay? So we could check the vertical line chart and see what that looks like, see if there's good buying in there from the volume and the price action. But we're not really looking at that. We're just looking at the point and figure chart. But we know this is sort of an interesting key clue here. We know that buyers are coming in along this line. Yeah, it dipped down below, but this might be an important accumulation area that we can start to pick up on the point and figure chart. It starts to become more obvious. Okay. Well, the rally up to M puts in a lower puts in a lower high here compared to K, right? Then we go sideways for a bit. And we can look at horizontal formations to the downside, and we've got counts of 8 and 10 from, let's see, from N here and O. 8 goes across here, and O is 10. Okay, so you can also make counts from M. What we're doing here on the down, let's just talk about it from the downside, and I'll talk about it later to the upside. What we're doing here is looking for points of either lower highs or really what we call tests to occur, where the last bit of rally occurs and supply comes in. So we call that the last point of supply. These are small last points of supply for Wyckoff people, okay? And this is where we want to try to take our count from when they exist. And so we've got one here that from O, we can count back. It's 10 figures across the O line, if you will. And so we would be conservative with this, and we would start at K, and we would count 10 down, and that would bring us to this level, which happens to be the same level as J, and that's exactly what the market does. And it comes to meeting that 10-point objective at P, where we also find support at the old low of J. Okay. Now things start to get interesting. Now we're finding support down here. Okay. Let's see. What I call points, some questions coming in. What I call points I and K an automatic rally. I and K. Possibly, yeah. I mean, yeah, we would. I'm trying not to put too much of the Wyckoff stuff in because I know that we'll do that more next session, mainly because there's some folks in here who don't have a good grasp of Wyckoff. Was F an oversold area? Was F an overbought area? Well, yeah, maybe. It might have gone straight up into that and gotten overbought. Clearly, there were no 1-point pullbacks in this move up for four points, right? More importantly, it just got nailed at B and the supply line. Selling climax? Yeah, possibly selling climax here. Could be climactic action. That we really can't tell very easily on a point and figure chart. Probably better to see that on the vertical line chart. Can we use the same principles of chart reading, trend line support, resistance, shortening of the thrust, and apply it to point and figure charts? Yes, and that's what I'm trying to show you here. And in many ways, Amar, the point and figure chart is clearer than the vertical line chart, because there's not as much noise. We cut out all the noise because we're only looking at 1-point figures. It's the kind of beauty of this. If there's no X or O, do you include that in the count? Yes. Good question, GP. So, for example, in this, there's X's and O's all across here, but look at this blank in here, right? Well, because we take the count over to its logical spot, we would count that, definitely. And in fact, I'm going to show you something even more wacky in a minute. And that is this. If we look along the 50, now we've come to support and we start rallying off of support. The X is going up, right? So we can take a count here, and there are 14 points across the 56 line. Now I'm going to start to use numbers, okay? Kind of got the basic concepts of kind of looking at these rallies and reactions and these counts along these lines and the lows and the shortening of the thrust and so on and so forth. Now we're going to start getting into the meat of this, all right? That was kind of an introduction, if you will. Okay, so there's 14 points across the 56 line. If we were to extend this, it's the 56 price line, okay? And that goes from P to J right here. So it suggests now a rally of what? Of 14 points from 56, up to 70, right? Up to 70 here, if the market gets going. So that's pretty good. Now we start to get interested in this market. We get interested in this market to the upside, right? So we've seen several bullish indications here. And I just kind of noted these out. Just go through them quickly. We got shortening of the thrust on the down moves. We've got the break of the supply line. We've got increasing demand, especially on I and K rallies, right? We have a last count of objective from O to K that was to the downside. It's met, and it exhausts that last supply based cause. And then at support that was established a couple of months ago, so it should be significant, and we've got a decent count here for a worthwhile trade. Okay, so this is how we craft a Wyckoff story. Multiple elements from multiple sources on the chart that together give us a strong bullish picture or story, okay, for this market. We don't jump in and out of the markets like lunatics, just hit, because we get one little indication or we get, like my favorite is like Japanese candlesticks. You get a jumping doji or whatever they call those things, and people want to jump into the market, or three dancing crows or whatever they are. That's why people have so much difficulty trading. This is the way to trade. You build yourself a story. You allow the market to construct a story, and you build and develop in yourself the skills to be able to read the story that the market is telling you. This is what Wyckoff meant by reading the market by its own actions to determine the likely next move of the market. Okay? So we have all this stuff going on. Shortening of the thrust, breaking the supply line, last objectives are met, supply is exhausted, support is giving us a good count. So we take the business risk here, okay? We can buy this at the danger point, and we can have 1 or 2 point stop for a nice risk reward, okay? The count is, what do we say, 14, and we're going to risk 2. So that's a 7-to-1 risk reward to risk trade. That's what we look for in this method, okay? That's what we look for in this method. However, there's a big but here. It would be pretty aggressive, this trade that we're talking about, even with all of this going on, because we haven't really seen any strength come into the market. All we see is support holding and supply being exhausted. Okay? So we want to see more than that. I've cleaned up the chart a bit. You can see the 14 points here from J to P. Got that down here. Let me erase all of this. Okay. And now the market rises up to Q, just above the halfway point from K to P. See how the halfway point really does start to play into here? Now, if this were bearish, we would likely not see it go all the way up to Q, but we would likely see it kind of die off around G, where we had support come in at G and L. That should be some kind of resistance if we still have bearishness in this market, okay? We saw the market checked down here, so we would expect it to be. But we go over that G and L line. I've put that in here in red. And it rises up above that. This is the G and L is on 60, okay, the 60 line. It rises up above that to go to Q. And then what happens? It comes back and tests it, okay? So this has the effect of broadening the count to an objective of 73. What happened here? Let me see. I've got it. Sometimes I forget these charts that I put together. So let's see, 14 to 56 goes to 70, and then 1, 2, 3. Yeah, we can broaden that a little bit, and by adding these three counts. So in other words, we'd broaden this on the 60 line from roughly what's at here at R back to J. And so while this was 14, now we've got 17. I would still take it off of the low at 56. So 17 and 56 projected up to 73. Okay. It also puts the market into what Wyckoff used to call an apex or a hinge. If we go back a little bit to the chart. And some people call this a triangle, all right? But the market narrows down dead center into the trading range framed by J and K and P, right? This trading range in here. And now we're dead center into it, and we've narrowed it down. This is a springboard position, okay? And it's occurring on the 60 line right where we've seen buying all the way back to G, okay? All the way back to G. So we've got to count up to 73. And if the 60 level or G level is accumulation, this count could even be greater. No, sorry. This count could even be greater. I didn't put that in. Along the line of 60, and we would get an even larger count up. Okay? Maybe up to 83 or 85, something like that. All right. The other thing I want to point out here is that notice that the supports are lifting in here from P to S. S is the high up here on that column. Okay? And we read this to mean that supply has become scarce as a result of this accumulation period that's been going on since early July, or from early July to mid-April, and maybe even all the way back to late February. So this rounding up also suggests that a markup is near. All right. Okay, let's lots of questions here. The count suggests a possibility of a rally target, or that it is likely or probability. It's just the target. It's just the target. Other things have to come into play. I can make you counts all over the place. I can give you, and we're going to do a down count in a minute, but I can give you, we can make a count along the G line in here and say, well, we're going to go up to whatever, how many points this is. And it doesn't happen. I can make those counts all over the place, but it doesn't mean they're going to happen. We have to make a story out of this stuff. We have to piece multiple things together from multiple sources. And that's what I'm trying to show you here in the point and figure charts. That's the advanced use of point and figure charting. P&F charts can help traders to not get wrong-footed by jumping into the markets based on price bar expansion. Yeah, absolutely, Sharif, absolutely. How long does it take for a beginner to grasp this? Oh, you got to spend time at it. You have to spend time at it. It takes time. There's no question about it. You want to make a lot of money and be a successful trader. It's all skill-based. And this is the kind of skills that you need to have. I guarantee you that this kind of an approach is going to be hands down a whole lot better than looking at a couple of indicators and reading a textbook that somebody wrote on when the indicator does this you can buy, or when the indicator does that you can sell. That's not really in my book. That's not really trading. Count projections are based off of support and resistance areas. Yes, and testing areas. So when it was talking about projections from accumulation and distribution, it was always taken from point and figure charts. Yes, that's right, Lars. When he talked about that, it was always from point and figure charts. would I think of IKQ as a creek? Yes, definitely. For those in the Wyckoff, looking at the Wyckoff playbook, this would be the creek of supply in here. And you can see we have a jump across the creek and a back up to the edge of the creek. Okay. Would it be right to say that the primary use of a point and figure is the structure and the secondary use is the count? Yeah, I would subscribe to that, Krishnan. Absolutely. Because we're always looking at structure first, and then the count is really secondary. But you'll see this is unbelievably accurate when it's done properly. Steve says this is very good. I'm glad you like this. I'm hoping you guys get something out of it. I put a lot into this. And I know, it's you're sort of drinking out of a fire hose in a way because I'm giving you a lot of information. But I thought the best way to do this is to walk through a stock like this using just the basic 1-point figure chart, because I thought that would be the way to really understand, as I said, organically on how to understand point and figure charts and how to really use them. Remember, this comes from 1850, for goodness sakes. And here we are in 2015, and look at the information this thing gives you. It's unbelievable. To me, anyway. Where did I get my training in point and figure charts? Through the Wyckoff course, a lot with David Weiss, and a lot of trial and error on my own. Are projections potential or probable? Do you differentiate? I would call them potential. They become probable when I have a story behind me. Okay? What's the best way to get started learning this? You're going to learn a heck of a lot between tonight and next Tuesday. So I would focus on this. I would focus on this first and foremost. All right. So that's I told you there's a lot here. So that's part 1 of Apple. All right. Let's do part 2, and then we'll take a 5 or 10 minute break. Okay. And I'll feed the dog, and everybody can go to the bathroom or do whatever they have to do. Okay. So I want to get back to the situation. At N and O, you might be thinking, well, look, at N and O, we're in a downtrend, for goodness sakes. The market's making lower lows here, lower highs, lower lows, lower highs, still lower high. K is lower than I, and J was a lower low here. And now you talked about rounding up. It looks to me like they're rounding down. Okay, I'm getting lower tops here from K to M to N to O. And there's also a count, for God's sakes. If I look at it carefully, I got this count at resistance in here from the O line. We can go back to, what is this? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 18 points all the way to here. And gee whiz, even more, I can add another dozen if we go all the way out to F. This market could go down to 48 to 36 with that count if we extend it all the way over to F, right? So you might be thinking that. And it's easy to think that. Okay, so let's say we go short somewhere around here at O. 3 things to note. First of all, while this may be a count all the way back to F, and we may go all the way down to 36 from wherever we are, 65. We may have a 50% drop in this stock. This is a trap. The big trap is to see this huge count. I told you I can make them up almost anywhere. And you think that the market's going to go there. And, that's kind of understandable because these counts and targets can be just uncannily accurate, as you're going to see when we go forward here. But we don't want to lull ourselves into making mistakes based on greed, okay? Our protection here is always to be conservative. I guarantee you're going to see counts like this and you're going to get excited. Don't. Be conservative. So being conservative means that you always, always, always go for the conservative count first, not everything else behind it. Okay? If the market pushes down through the conservative count, that's great. That's great. Then you go for the next phase. We break these up into phases, and next week I'm going to show you how to break them up into phases. Show you exactly how to do it. Okay? So if it breaks down through the first phase or first count, then you go to the next one. That's great. But look at what happens. We're short here from O, and our initial count ends at K. Okay? Got a line in here. And we said that that's like 10 or 11 points. Okay? And we project that down, and lo and behold, it comes back to 56. And the market stops here. So, and then starts to rally, and it goes beyond the halfway point. So that immediately tells you you don't want to overstay your short position. Now you want to get out. Okay, and we've got a rally up to Q, which is beyond the halfway point from K to P, right? Or actually from O to P, excuse me. Also, it's from K to P, and then Q wipes out most of the move from O to P. Okay, this was a swift move down, and then from P to Q, we rally right back through it. Pretty much with ease, with good flow to the upside. We got strong flow to the downside, and then flow comes into the upside. So this market is acting stronger than you would want if you're short. Okay? So take the cue that you're stopping at support and you're getting a rally that's wiping out most of your downfall here. Take your cue and scratch the trade. Don't hang on because you got a big count. You have to be able to read the market too. So it's not just enough to make counts and then trade them. Even conservative counts. You've got to be aware about what's going on in the background. And here, just to kind of reiterate, we got shortening of the thrust, we got the break of the supply line, we got pushes up here on rallies beyond the halfway points. Demand is showing up on I and especially K. Support's holding here at P. You don't want to be ignoring this story that's unfolding because you're short and you got this big count behind you. All right? Does that make sense to everybody? You don't want to be ignoring the Wyckoff story. It's a really key idea. And few traders understand this. Few people understand this. And it's natural. Human beings want the simple, direct approach. But trading is not simple and direct. It requires a lot of effort, a lot of thinking. And one of the nice tools that we have is to use point and figure charts. Okay? All right. So Sharif says, with a count projection from G to J, how would you know it's a projection to the upside or the downside? Well, you want to be basing it on your story of strength coming in, but I just showed you that if you missed that, you still have a chance, right? If you're paying attention to the market here. But it's typical that the market comes all the way back after a change in behavior. The change in behavior with context says much, I think. Absolutely, Lars. And you would add that to your analysis. We're not talking about the Weiss wave or the vertical line charts here. We may have, for example, this, here's a strong rally up and we see demand coming in, right, on the volume. And we don't know what the price bars look like except that this move here from this low to K, well, really from J to K, but especially from this test to K, probably on very strong price action and probably on very strong volume. Then as we came back down, we get shaken out a little bit here, but most likely the volume's going to be low here, right? You can certainly piece that stuff together. Absolutely, and see this as a change of behavior. And note that, okay, changes of behavior, we often see this coming all the way back. And if you do, that's okay. What we're looking for is for support to hold. And then you got opportunities to go long in there all over the place. Okay? So yeah, absolutely. You're right on track there, Lars. Very good, very good observations. Okay, so let's get back to our study now of Apple. So we talked about what if we wrong-footed ourselves, right? Okay, so just to reiterate here, the counts from P to J are bring us up to 70, and then R to J brings us up to 73 off of the P level. Okay, and these are achieved. They obviously we rally up and they're achieved. Okay, then the market goes sideways for a count of 5 over here. I'm not going to draw that in. Then drops down to V. Okay, so this is pretty swift, right? This move down to V. Suddenly we were going up, and now V, we take out all the rally here from this test at T to U. We take out all that rally and we actually make a low down here. So is this the start of new weakness? Well, probably not. Probably not. How would we know that? Well, at U, what happens here? The market's just made a higher high over resistance at K and I, right? And look at the rally up compared to, remember we were counting? We're not going to count again, but this is like 14 points. We had 10 points, we had 7 points, we had 6, and we had 3. This is strength coming into the market here. Buyers, bullish people are coming in. Okay? So it's unlikely it's going to turn all the way back down and start making lower lows. There's also no substantial count from U to V. Only 5 points here along this line. 1, 2, 3, 4, 5. Okay, just 5 points along that line. Right in here. So we'd need at least a count of 17 to take us all the way back down to P. And we don't have that. And then V goes to the halfway point. It's swift and it's sharp, but it's still at the halfway point between P and U, and that's a normal reaction. And it's coming into the support from this congestion area, this old resistance that we had all throughout in here, and actually over in here too. Okay. Then, even though this is a swift move down to V, the market immediately comes all the way back up to W and pretty much takes out most of the sell-off on V. So we would begin to think about this as an ordinary shakeout. The swift move down that doesn't continue to be followed, it takes the breath away from you for sure, but it's immediately retraced. Okay? And notice that we're holding support along the 69 line here. And if we're thinking about things, we can draw a demand line off of P and V, and the market works its way over here at X right to the demand line. So we can make a count at the 69 level of support, and we've got 13 69s here for a potential move to 77. We would take the low at V, which is 64, and add 13, and that should bring us up to 77. My math isn't always that great. And this is a conservative count. Whoops, sorry, I'm getting ahead of myself there. This is a conservative count, okay? We can also add the 13. This is a little wrinkle now I'm going to introduce. we can also add the 13 to the level of support at 69 here, or X. So we can take this. This is important to know, especially when you've got some space like this between the two lows here. You got a low here at V and you got a low here at X. And we got a count of 13. We take the conservative count from V and project it up. We can also take that same count and project it up from 69. We can do both. And we'll talk about how to compensate for that by thinking about the area in between in the next session, but just sort of as a kind of a highlight there. Is this making sense to you? Was there going to be a break? Yeah, I'm going to take a break in a moment. Can we see springs and upthrusts in PNF charts? Yes, you can, but V is not a spring. I'll show you. Well, you'll see a spring, I think, a little bit later on in this. Okay. So now we can go back to we can also go back to our initial count from R to J. All right. Oh, the other point here, where am I now in my charts? Oh, I'm way behind here. Sorry. So we're also in another apex here. We're also on the hinge, right? Where we have a trading range between U and V, and we're dead set in the middle of it, and we can narrow that down into like a triangle or a hinge or an apex, and we can make our projections. So as I said before, sorry, I got lost in the charts here. We can take that count here of how many did we say it was? 13, I think, and we can go. No, it's more than that. Let's count it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. It is 13. So we can add it to 64. That brings us to 77. And we can add it to 69. And that brings us up to what? 82 or 83, right? 69 and 13 brings us to 82. Okay. Now we can also go back to R and J. Let me catch up to my yeah, here we go. And we can say, remember we said demand looks like it's coming in at G, and we get support here, and we get support at L. So we can extend this out. And when we do, this adds additional figures to our count. And lo and behold, that brings us up to 82 as well. All right. So we can start to see, and we're going to talk more about this next session, that counts can confirm other counts. And when they do, they also give us an indication as to timing. But we're going to talk about more about that next time. All right. Just wanted to introduce to you this idea of a charting system that was developed back in 1850 and is nailing Apple last year or 2 years ago, a year and a half ago. Okay, and then as we come to Y, right, we're still on this support line, demand line. We've got a count of 9 figures along the 74 line, and we're at support here at U as well. I didn't draw this in because it's getting complicated, but we can extend U across, and we're at support. We got all kinds of support going on here. And we're in a small hinge or apex. So we can add the 9 figures to the low at 73, which is at Y here. And we have yet another confirmation to 82. Isn't that amazing? This is not unusual, by the way. So you can see how the old charting developed back in the 18th has some remarkable application, all right, to today's markets. And I picked Apple on purpose, not because I thought this would give us, the best way to look at the point and figure chart. I picked Apple because I thought it was a good challenge. I hadn't charted out Apple on a point. I haven't traded this in a long time. I haven't looked at it in a long time, and I wanted to see, I wanted to put, this old style of point and figure charting up against what I can consider to be one of the top modern stocks of the 21st century, at least the early part. Okay, so I wanted, and I think it's holding up pretty darn good so far. So for accumulation, says Lars, you're looking for a possible clear sign of strength coming in and then start the count from there. Doesn't have to be, no. The accumulation, we can start to see it holding in here at G and L, and we would see it holding there again at R. That often happens. We're going to talk more about this next time, the next session, how to anticipate these things a little bit better. I'm trying to give you the flavor of all of this now. But, we started off, remember, go back to the recording on this. We started off simply with P and J having a count, I think, of, 14 and taking us up to 70, something like that, right? And we thought, okay, that's a pretty good move. From 56 to 70, that could be a nice trade. And so when we started to see strength, we might have bought in here at this, or maybe at this, either one of these tests. Okay, we'd look at our vertical line chart for our entry opportunities, and we would be long from about 60, and we would have a halfway point between 60 and 56. So our stop would be down in here somewhere, and we would look for a trade up to 70. But as we go along, we see the strength coming in at 70. So now we can expand that by looking from R to J, and that brought us up to 73, and that's where the market went. So we'd be conservative, and we start to see the market go sideways. We might still hold on to a piece, or exit out altogether, whatever we would do. But we see that we get shaken out, and then we go into a sideways range, and it's holding supports. There would be other indications on the vertical line chart that we would be looking at to give us a sense of are we still poised to go up. But we have higher highs in here. We can make a count up to 82. We can extend back, and we can see, there's a confirmation. This probably therefore was a line of the area of accumulation that we were talking about. Okay, so yeah, like G to I, that's right. So let's take a break. What do you think? I think I need a break anyway. Hopefully this is helpful to folks. Let me just see where I am on the charts here. Yeah, so we'll come back, and we've got 3 more parts to do. I said it would probably go over 2 hours, and I'm not wrong about that. So let's come back at, how much time do you guys need? Do you need more than 5 minutes, or do you want 10 minutes? What do you want? I don't want to go 15. That's too late. 5 minutes is good. Yeah, that's okay. We'll come back at 7:05. Okay? 7:05. And I'll put this on pause. Okay. All right, so we're back. And now that you're starting to get the concepts down, I'm going to probably try to go a little bit quicker so we can cover this material tonight and get through it. Okay, so if you remember, I'll just go back quickly. We rally up to 82 here, right? Everybody can see that, I'm sure. So we rally up to 82. So let's see what happens after that. So here we are at 82. There's the rally to 82. Okay. And now I mark it as Z here. And after we rally up to 82 at Z there, the market starts to go sideways. Okay. And then it goes sideways for a little bit, then it falls to AA, taking out the supply line. I'm sorry, the demand line. That's the green line here, okay? And exceeding the halfway point from Y to Z. You can see that it's pushed down below that, okay? So at this point, we have to say to ourselves, we're either going to have a larger reaction. And remember now, we've gone from a low of what, 56 or 55 all the way up to 82. So that's a 25-point run. That's been pretty good. So not a surprise to get a larger reaction, is it? All right. So we have to say to ourselves, we're either going to get a larger reaction, which is not really a surprise, or we're going to get a downtrend, possibly a new downtrend. All right. So we've got to be aware of that. And we get a rally up to BB and we put in a lower high. And then the market goes sideways. So either the larger reaction or a new downtrend, one of the two is going to happen. All right. And BB tends to confirm that. So at BB along the 80 line, we can make a count. We've got 11 80s. Right, this is 82, 81, 80. We've got 11 across here for a projected target of 71. And that's all the count we have at this point. Could we go larger? Yeah. If this initial count comes down to 71, doesn't stop there as it does, we can make a larger count. Right? We can do this. And then that would project to something different. But as I said, what protects us in this is taking the conservative count first. The conservative count's going to be the smaller count first. All right? And we'll refine how we take counts in the next session on the count guide. Bob Evans did a remarkable job in creating the count guide. And you'll find that that's a very valuable tool. Combining this kind of information that I'm giving you tonight on the fundamentals and then refining it with the count guide, you should be good to go in terms of point and figure charts. All right. Okay, so now the rally up to DD suggests what? It suggests that supply may not be dominant, or at least demand is still present. Right? We come down swiftly here to... It comes down swiftly to 71, and then it rallies back up almost just as swiftly, taking out all of those lows, taking out all that swift move down. Okay, so demand hasn't gone away; it's still there. It's still strong, and it goes more than halfway from BB to CC. Okay, from this leg to this leg. That was 9 points. So we should have stopped at 4 or 5 points, but it goes up to 7 points, okay? And then the market settles into a 4-point wide sideways move for the next 3 months. So whatever supply that was there just isn't there anymore. You know, if we were starting a new downtrend, then we would be looking for the market to roll over and go down. It starts to go down, it makes a lower low, it makes a lower high, and then goes sideways. Well, that's not the way downtrends work. Typically, we would see this market move south from here. Steve says he's lost audio and slides. Has everybody else lost audio and slides, or can you still hear and see me? It's all okay. Okay, good. Why, Roy says, why do you think the count works so well to give you targets? Because this assesses distribution and accumulation. Next time we'll talk a little bit about how the market, phasing of the market works, and hopefully it'll become a little bit more clear. But as I said, and as your own experience, you know markets don't go up and down on dimes. They will go sideways for periods of time. Congestion areas are typically areas of accumulation or distribution. And it's the point and figure count that is so bloody accurate in estimating what the move out of these congestion areas is likely to be. Okay? Would it not be adequate to think that sideways could be cause for a potential down move? Well, you could consider it that way, except that we are just going sideways in here for all that time. And we're sitting on top of support from the first move off the lows here at V. So if we were to extend this line over like this, we're on top of support there. Okay? So there it is. There's that line right there. And we've now necked down into another apex position. All right? Another hinge. So we can take a count along the 75 line from EE to CC, conservative, right? And it's 12 points. And we can project that up off of 71. And we can also, that's the conservative level, we can also project it off of 74 as well. There's a couple of points difference there. So we get a projected target of 83 to 85. And we can see that at the market pushes up to that level. All right. Hang on a second. Yeah, okay. So now we rally up above resistance here at Z, and at FF, the market holds up on top of the old support at Z. So we can take a count here at the 84 level, but this is only 5. And we've just had a pretty strong sign of strength in here, pushing up above all this months-long resistance, and rallied up. And look at the markup here, how strong that markup is, right? So we can go back to the 74 level, our original count area, and see if there's another phase. And there are several, in fact, but we'll just go from EE all the way over. And we make projections from 104 to 107, coming off of the 71 line and the 74 line, going all the way back. We would make this count first, being conservative. This would add 1, 2, 3, 4, 5, 6, 7 on top of 85. So that would bring us up to 92, which is roughly in here someplace. But the market continues to grind up, so we would then extend our count out to this level, and that brings us up somewhere between 104 and 107, and the market hits 103. Okay? If the market continued to go higher, we would extend it even further out to here, and you could even make the case that you could extend it out here if the market continued to go up. Right? That's how we use this point and figure count on a very conservative basis. Okay. Okay. Would it not be? Oh, I did that already. One could see the area from Z to DD as rounding over, especially after the move to CC. From Z to DD as rounding over, especially after the move to CC. Yep, you could. And you would then take your first count from here Okay. Well, okay, let's back this off. So let's say you saw this DD, that you ignored this strong move up, and you said, I'm going to ignore that because I've got rounding over and I got a push down, and we're going to ignore the fact that we just bopped right back up again. All right. And I've got a count here along this line of 1, 2, 3, 4, 5, 6, 7, 8. Okay. And I'd project it from this level, which is 1, 2, 3, 4. 1, 2, 3, 4, 5, 6, 7, 8 down here. Okay. So here's my count and my projection. And the market falls and goes sideways, and we're in this for February, March, April into May. 1, 2, 3 months, maybe 3.5 months, and I'm going nowhere. Okay, I'm just stuck in the middle here. I mean, you can continue to make counts the other side, but it's telling you that you're not going down. You've got a count that's not being fulfilled after 3 months. We want to get in at the market at the danger point, which means two things. That if we're wrong, we only have a small loss. And the second is that the market should move fairly quickly away from the danger point. Okay? And this isn't doing that if you do this in here. You're not doing that. And you're not meeting your count. All right? So, okay, good. Could CC have been a spring after a shakeout? Nah, I wouldn't consider it a spring. From here, you mean? From Y? Maybe. No, I wouldn't. I wouldn't see it as a spring. I like springs to be very obvious. That, to me, I'm struggling to find the spring there, so I would say no, Ted. I would say no. I mean, look, there is a point to be made, though. You've got a low in here, and you got a sort of a secondary low in here. But somewhere in here is support, and it goes underneath support, and it bops back up above it. So while it's maybe not quite a spring, it's telling you that the market is more bullish than bearish because it's not willing to push down. It's not following down through below this level in here, this Y level. Okay? So yeah, in that regard, you can think about it as a spring. When you're adding, Michael says, when you're adding phases to the count or cause, do you refer also to any Wyckoff structure on the bar chart? Sure, such as spring and so on, selling climax, etc., or stick only to point and figure and add counts based on price progress up or down. No, you would definitely look to, and that's what the next session is. What I wanted to go through in this session is the fundamentals of using, well, really, it's more than fundamentals, but the main principles, the major principles of using point and figure charts, just off of the point and figure charts alone. I didn't want to complicate it with vertical line charts. I'll complicate it next time, okay, the next session. Is this chart built on daily ranges? It has nothing to do with time, Larry. It has nothing to do with time. It's built off of 60-minute highs and lows. Okay? 60-minute highs and lows, and it's a one-point figure chart. Okay, so you can see that the market grinds up to 103. We didn't quite get to 104, 107, but that's not bad, right? So it's a grinding market, which suggests that buying is there, but it's not as strong as, we don't have really strong flow like we do from EE on up here. We've got a grind. So that's not bad. Okay, so let's go on here. So we reach 103, which is right here, right there. And then price flattens out at A, right? Sorry. Price flattens out at A and makes lower tops here. at B, a lower high, so to speak. So the market wants to react before going higher. All right. Now, there's lots of counts available here. You might be thinking, okay, this is a market that's all set to go flying down. Okay. So we can make a count along the, for example, along the 102 line. We've got a full count of 23, and this would project us down somewhere around 79.80. It's off this chart. It would go so low, right? So we get excited about that. We could also make a count of 25 along the 101 line for a run down even lower to 78 or 76. I'm not showing that here, but you can sort of see that right in here. I forget if 101 is there, or maybe it's over here. You can make all these counts, right? And you can build up pretty strong indications that, this thing is gonna. But do these large counts make any sense? Think about it for a second. Does this large count really make sense? Look, the market's in like a 6 or 7 point range in here. From 96, 97 on the low to 103. And it's going this way for 3 months. I don't see any sign of weakness. No major break or any upthrust in here. And coming into this trading range, the market was grinding up. There's no preliminary supply. There's no selling going on in here. It's just eating through whatever supply exists. All right? And it's holding gains for several months. So large counts don't come into play here. Right? They don't make any sense to make a large count here. All right? No, yeah, Lars says there's no change in behavior to the downside or other kind of weakness. That's right. And can't you see it here in the point and figure chart? This is beautiful. We just are holding gains in here so nicely. So big counts like I just showed you here off of the 102 or 101 line doesn't make any sense. Okay? All right. So if we were to do a count, we want to be conservative, all right? The first logical phase along 101, the 101 line, is 7. We got 1, 2, 3, 4, 5, 6, 7. Okay, yeah, you can go all the way out and project it down below 80, but that doesn't make sense. Why? Because this thing isn't going anywhere so far. If you're still convinced that you want to be short, take your conservative count first, okay? This brings us down to around 96, 94 target, depending on, if we do it off of here, it's going to be 94. And if we do it off of the A level, it's going to be 97. We want to be conservative, so we do it off of the A level first until the market tells us we can be a little more liberal, okay? But what happens? The market finds support at 96, and it hits it 3 times here at C, right? So, okay, we were short. We had a small little trade. And 3 times down here at C, the market holds. We check our vertical line chart now to see if we have a spring, which I think we probably did at this point. Okay. The market dipping under 97 support and then rallies up here. And then has a test at D. Springs in an uptrend. A spring is nothing more than coming to support. Here's the support level here at 97. Going underneath of it and then not following through to the downside, but instead coming back up again. And sometimes they test. After you see a rally up, it comes back and tests that spring with a small volume, narrow range kind of pullback, and that's what we're seeing here. We can see it on the point and figure chart because it only went back 1 point before it started to rally up. Okay, So springs in an uptrend are always a high value trade. It's something we always want to be looking for. So we can either buy the spring or we can buy the test of the spring. We can either buy it at C or we can buy it at D, right? And then the question is, how far can it go? Well, let's take a count. So if we took the spring outright, our initial count will be along the 96 line, right? And there's 21 figures, there's 21 96s here, right? And so 21 plus 96 brings us up to 117. And we can also take a count off of the test here at 98, where the spring was tested at D. We've got 23 98s. And so, and there's larger counts too. We can go back further than this, all the way back into here, and even farther than that, over to here. But we want to be conservative. That's our protection when we're using point and figure charts, okay? So we get a count of somewhere between 121 and 119, and where does the market go? To F. Look at that nice move up, and it stops dead at 119. So the conservative counts between 117 and 121, the market reaches it before reacting. And notice, all the way up, just 1 point reactions, all the way up. Nothing deep, no supply at all coming into this market. Just normal corrective reactions. Note too, this is what I was saying before about risk and reward. Notice the nice risk and reward. We get a stop just below 96, and it doesn't matter whether we take it at 97 or 98. We're talking 1.5 to 2.5 points. Even say 2 to 3 point risk, right? For a 20-point move here. So the ratio there is 1 to 10. That's what we look for. This is also a good example of Wyckoff's basic idea of playing near the danger point, because we're at support, and in this case we've got a good count behind it. And so if it didn't work out for us, we're only going to lose 2 points, 3 points maybe. But we've got that opportunity to pick up somewhere between, 17 and 20 points on a trade like this. Now, also, here's another interesting thing about this that I like the point and figure chart especially for. And that is that although we try to buy in or sell against the danger point, there are times when Wyckoff would have taken a break of resistance. A and B is resistance here, right? Buying the break. And this is when we would do it. This is the least preferred because we're far away from the danger point if we're buying a breakout. But in this case, it's a good play. Why? Because we've got a large conservative count and good sign of strength on the rally here from C up to E. Okay, so a breakout here, usually the least favorable entry, because it's far from the danger point. It happens to be a good trade. And so our stop would be, in classic Wyckoff terms, a little bit below the halfway point between E and C here, somewhere down in here. Okay, and if we bought down closer to the danger point, this would be a wonderful spot to add on to. So let me just kind of rephrase all of this or paraphrase all of this. The best times to take trades are when we know that there's strength coming into the market, and particularly when we're close to the danger point and when we can find tests near those danger points, okay? And the danger point here is the 96 level, and the test is at the 98 level. So if this trade fails, we're not taking a bath, so to speak, okay? The least favorable is to buy the breakout of resistance. So, and you know, people always say, yeah, that's always the least favorable. But when would Wyckoff take a trade? When would he take a break of resistance? He'd take a break of resistance when there was a strong sign of strength behind it and a large count on the figure count, so that taking the break made sense. Okay, I hope everybody understands that. There was earnings there. Yeah, I'm not surprised. I'm not surprised. You know, news is just, it's always reflected in the charts. 90% of the time, it's always reflected in the charts. I never really think too hard about news and stuff, earnings and all of that. I'm aware of it, but you know, if I were looking at this and knowing that earnings are coming out in this area, I would be thinking to myself, boy, the earnings are probably going to be good. And that's kind of what happened. Any questions on this so far? It's good stuff. Okay, good. Good. I'm glad to hear that. All right. So let's go on then. Let's continue with Apple. Okay, so it reaches its objectives when it hits 119. And so we would expect a reaction at that point. That's another thing. When we do hit targets, we expect reactions. All right? I mean, that kind of makes sense, but I just thought I would say that in case, you know, don't. So think about it this way. I've worked with a lot of different traders over the years, and a couple, well, more than a couple, several, always had trouble kind of taking trades off when they should have. They held on to them too long. Usually the trade that they were in yesterday or a week ago took off, and they you know, the market takes off. They were in it. They got a nice ride, but they exited their trade, and then the market continued for, you know, another gazillion points up or a gazillion pips up. And then they're kicking themselves. And so then they vow, I'm not going to do that again. I'm not going to leave money on the table. And they would overtrade their position. They'd hold on too long, and the market would react, you know, come back against them, and they'd either lose a good portion of what they gained, or even sometimes they even took losses, losing the whole thing. So it's another area where point and figure charts are really helpful, because that will help the trader who has that difficulty of not wanting to leave money on the table. It gives them a marker against which they can trade against. And when it hits that point, they can say to themselves, okay, fine, I'm not worried about leaving money on the table, because there's, you know, most likely there's no money left on the table here. All right, so after we hit this objective up here, then Steve says, are these 60-minute charts? It's not time-based, Steve. These are one-point figure charts based off of 60-minute highs and lows. But the key thing is that they're one-point figures. Okay? It's not that they're built off of 60-minute charts, but they're not 60-minute charts. Okay, so now we start to react. Now look at this reaction. It's a little different than what we've seen in the previous reactions. Here we're starting to see lower lows at G, okay, being made down here. And we can see that the down moves here and here and here are mostly larger than the upswings, right? So seeing this, we know we need to wait for the lows to bottom out. And they do finally at H, right? So do we take a trade here? Well, there's only a count of 5 across the lows. You know, if we box this in, I can't remember if I boxed it in or not. Let me see. No, didn't. So there's only a count of 5 across here. The 3 figures and then the 2 spaces in between. Okay. And so that would only take us up to 112, which is about the halfway point from F to H, up to 112, which is basically where this market goes. Okay. Not a surprise. So there's 2 things to note here. First, the market runs up to 114, which is a little bit higher than the halfway mark. All right, we're at, I think this is 119 and 107. So if we average that, it would be, would show us 113, I think. 112 and a half, 113, something like that. So this is showing a bit of strength, right? And the rally from H to I was pretty strong. Compare that to the prior rallies. Up here and here and here and here. Suddenly we're getting some life coming in. Okay? Again, it's not telling us jump into the market. It's telling us to perk up our ears and be alert. All right? It's suggesting that we're starting to see a little change in behavior and that the down move can be coming to a close pretty soon. All right, but then we get a move down to J, we make a lower low, and it's pretty swift, that move. So if we took a conservative count across the 113 line, let me see what I'm talking about here. We had 4 113s. Okay, here. 4 113s. And the move to J is 1, 2, 3, 4, 5, 6, 7, 8, 9 points. Okay? So this suggested 4 or 5, and we get down 4 points rather. This gets down to 9. So we have to note that supply is still in the market. All right? Now notice we get a spring here, but we might not want to take that spring because of the way this market is acting here. Didn't hurt us necessarily if we did, but we sat through a lot of stuff here, nonsense here, okay? But so kind of what I'm saying here between the lines is that the point and figure chart can keep you out of a market when you ought to be out if you're reading it correctly, all right? This kind of move down here suggests maybe not the best. I'd wait a little bit and look for a sign of strength to come in. Kind of wait for further developments. So then the key question then becomes, is this really supply entering the market? Well, the next rally is usually going to tell us whether there's supply or not. All right. So the rally up to K gets checked around I, a little bit less than that. But it's swift and it's strong. So that suggests demand is coming in. But you may still be stubborn and think, okay, this is going to be weak and take us down. So we make a count along the 112 line. And there's going to be, 10 figures across here for a projection down to 103, 102, 104. I think this might actually be a mistake because it's 114. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, so this should read 103 to 104, not 103 to 102 to 104, not 103 to 104. Sorry, I made that error. So yeah, and you might even be thinking, oh, okay, this can even go down to 93 or 85. Make a really good low down here. Because if we look across, there's like 20 some odd figures across here. And so we could get, like a big move down. So let's say you get short around 12, all right? But look at what happens. First, we don't get a swift move down, do we? We moved down really fast earlier from I to J, and now we're not making that kind of swift move down. Let me clean this chart up. And then it's much more choppy. We don't get that swift, from I to J is a good standard, and from K to L, once I clean up the chart, you can kind of see it's just not doing it for us, right? And we start to hold a higher low after coming down here to 106. Instead of going all the way down to 105, we're holding a higher low here at 106. And then we rally back up above the low of 107, where the market was supported at H and at J, really several times before, okay? So we're not making our full count. We dip down below this level twice now and then push back up above it, and it seems like at 106 we're testing it. So we have to be saying to ourselves, we can't be short here. We've got to get out of that short, and really we want to be long, because what we're seeing in here is support holding along the 107 line. And we can make a count here, and that projects up to 125, 126, 124 area. Right? There's 19 across here. You add it to the low of 105, and you can add it to the 107 level. So we would be adding the 19 to this and to this, and that would project up to 124 to 126. Okay? And when we make that projection, it'll take us above resistance. Note, too, that we're also just a little above this line over here, above support. All right? Now, as we approach 125, we would note that we're moving really strongly. We're pushing up. I mean, we're not getting, we drive up, we go sideways for 2 points, we drive up 2 or 3 points, we drive up. So odds favor we're going to exceed this count. So we can take a more aggressive count. And we do that along the 110 line, where the market came up and came back down again. Okay? That gives us there's 23 figures across here, if I added correctly. We add that to 105 down here at J, and also at 110. And so we would get a count from between 128 to 133. All right? And look at where the market goes. It hits 133. Okay, some comments here. Am I going to explain springs next week? Well, we'll talk about them in context of point and figure charts. What about the background with that big move? Well, you've got that big move up. Yeah, you've got strength in here. And we're coming off of this low here was around 97 or so. We go up to, well, we know what it is. It's 97, 96. And so we go up 20 some odd points here. That was a nice move. So you would expect some back and fill here. And we started off at 56, I think, and now we're up almost 70 points, 60 points anyway, 63 points. That's quite a move. So you would expect some back and fill. I mean, that's natural. At the bottom of window, it says audio not connected. Does that mean it's recording without audio? No, that doesn't mean that. I've got audio connected. Don't worry. My God, if that happened, I'd be really upset. Would you call the change in behavior, or would you call I the change in behavior, or K? I would call I the change in behavior, and K confirms it. It's kind of, but from I to J still shows supply, but K is confirming that demand is really pushing hard here. Could this be an inverse head and shoulders? I don't know. I don't really think of those. I like how point and figure chart is also tool to confirm or disconfirm supply or demand, and also indicates obvious ease of movement or swift reverses. Yes, it does. It's wonderful that way. It's a lot to be said about this point and figure charting. All right, so the market hits 133. Let's see what happens next. We've been going up all this time. Let's do the last part of this as we come on to 8 o'clock Eastern time. Almost 3 hours. Sorry, and we didn't even, I was going to try to do all of do the count guide in 2 hours, and I knew that it wasn't going to happen. So that's why we're doing 2 sessions. Yep, there is a jump across the creek and a back up. That's right. That's what you were seeing here with this sign of strength. This is, again, resistance. You jump across that resistance, or what they call the creek, and now you're coming back up and testing that resistance to see if it's good support, and it is. And the market pushes higher. We'll talk about that next time. Okay, so now let's take a look at the last segment here that I want to do tonight. And this, we've been looking on the upside. We started off looking at the downside, and then we were looking at the upside. So let's look at the swift move down into August. Everybody remembers that. Surprised everybody except for those of us who've been tracking this stuff. We were talking about in deep practice that we were anticipating a decent move at somewhere in, I think we were talking about this in June and July, that we were looking at monthly charts and weekly charts. I think I brought in the quarterly chart at that point and said, we're getting shortening of the thrust in the quarterly. We could see a good move down. And that's exactly what happened. Okay, so let's take a look at this down move. So the market comes up to 133 at A. That's where we left the last set of charts off. Then it falls back 11 points to 122 at B. All right. Our last low was 106 down in here somewhere. And this is 133. So about 14 points is the halfway point, and this is still showing strength at B. Okay? The down moves are a little stronger than the up moves, but we're still overall seeing strength. Then we get a rally up. We start off strong, and then we pull back, still strong. We get demand coming in, then supply, and then demand. But we get kind of a lackluster rally here, and then we ramp up at C. This is suspicious, and then it just dies out. This is very suspicious. For those of you who follow Wyckoff, he talks about hypodermics. This looks like hypodermics right here. And you'll see in a minute that it looks like a swift move up that's kind of engineered, right? It comes up and then it doesn't go anywhere. It falls back immediately. We get a small pullback, 3 points, then it tries to rally up. This would be no demand in here, and then we get a swift move back down to D. Okay, and this down move suggests this is hypodermics, and there is still supply in this market. Swift move up followed by swift move down says buying is hollow. That's what hypodermics means. It's like Wyckoff talked about having a patient lying on the table who's ill, and they give him a shot of adrenaline or amphetamine, actually, and he bops up and does a jig on the operating table. That's what this is. The guy's very sick, but it's the false drug that gives him his life. So the buying really is what I would call hollow. Buyers couldn't sustain it. You get that swift move up. Why didn't it continue up higher? Well, because probably it was engineered, is the way Wyckoff would look at it. But let's say you see the market hold at a higher low, and you buy then on the test of, hang on here, buy on T here. You say, okay, well, the market comes down, it holds here, and I'm buying this test. Okay, I got support, all of that. You saw this as a change in behavior. All right, once again, there's definitely a wide count along the 125 line. There's 28 of those counts there. And if we push that off of the 122, we could see a count up to 150 to 153. But we want to be conservative. This is what protects us. And so we take the initial count, which runs from here to here, and that's 7 points. 1, 2, 3, 4, 5, 6, 7. And this gets exhausted at E. All right? So once again, our protection is in the conservative count. And so we stop at E. So now is it going to go higher? Well, it goes sideways, and then we get a test of E at this T here, and then we start down. So it's not strong. This count is not showing us strength. In fact, we're seeing resistance develop strength, not demand develop strength. The resistance along the 133 to 132 line at A and C and E, this stock is faltering up there and puts in a lower high at E. Okay, then gives the test at T, and your long trade now is in deep trouble. So you got to get out of there as the market turns back down. All right. So one of the things to note that not only does these conservative counts protect us, but typically the point and figure charts, if we're in tune with them and we don't get too psychologically distraught about stuff, they can help us exit gracefully when we use them properly. Okay? So the market then moves down, and from the test of 132 here, pretty swiftly again. That's a fairly swift move, right? And falls lower and makes a new low down here at F. That's not a good sign, okay? But let's say we see this here as a spring. The market rallies up sharply, so we say, oh, great, possibility of a spring. However, the rally dies where? Right at resistance. Remember I said in the very beginning, point and figure charts give us clear support and resistance. And it dies off right here. And then that swift rally up is just as swiftly retraced all the way back down. This is not a sign of strength, it's a sign of weakness. The buying was hollow here because of this, hollow here because of this, and very hollow here because of this. So here's our situation. We've gone sideways for 5.5 months. And typically, the longer we go sideways, the less likely the original trend is going to remain intact. Now again, I can't tell you that it's 4 months, 5.5 months, 15 minutes, an hour, 3 hours. It's just, you have to, this is discretionary trading, and you have to use good discretion. And so when we've been going sideways like we have, and after really it's several attempts, right? You got 1, 2, 3, 4, 5, 6, 7 attempts to go higher and fail each time you rally. So it's got to tell you something, right? It's telling you that, you're not, the buyers are not able to put it together. So, and every time the market's rallied up, it swiftly retraces. That's not a good sign either. That's a sign of distribution. It's a sign of supply. And then we make a lower low at 120, and the last rally, which should have been a spring, fails. I mean, it didn't quite fail because it hasn't gone through yet, but it's about to fail at this point. So supply is dominating the market, and we can see that just off of the point and figure chart. We don't even need a vertical line chart to tell us that. That's got to be our conclusion, okay? So we would want to look for a short trade in here if we're trading this market. So we make an initial conservative count along the 132 line, right? That's our conservative thing, level. And there's 18 132s. And that gives us a potential for a target of somewhere down here of 114 to 115. Okay? That's 132 or 133 minus the 18 would bring us to 114, 115. So we see the market does that, but it's unable to rally in here. It can't rally up. and it's hitting resistance at 120. I don't think I drew this in, but we've seen this a number of times now where old support becomes resistance, right? So now we can extend, and now as the market starts turning down again here, we can look to see if there's a bigger count because we've just met this count. And so we can extend it out to C. And there are now 35 figures along, yeah, so now we get a total of 29 figures here along the 132 line, and that brings us down to 103, 104. Okay? But look at what the market's doing. It's making lower lows and lower highs down in here, and there's no indication it wants to rally. So what do? We turn to the point and figure chart again, and we can make a larger count. And we would do that off of the last rally here, where we came down sharply and then came back up again. And this was our last point of supply. Supply met demand right here. That's the last time it met demand in here. We can always see that on the point and figure chart, and then it started coming down. Okay, so we can get a count along the 120. That's the 127 line in here. We can get a count that brings us. This would be the next most conservative count after these two. And that brings us down to 92, 98. And that's exactly where this market stopped, to a dime. Okay, let's see some questions here. Can we use range and ticks to plot point and figures? I don't think so. I don't use those. Maybe you can, but it's not the way I've been taught to do it, so I don't know. Earnings again, says Larry. Yeah, so, if that's the case, Larry, then and this is a stock you trade or other stocks you see that respond to earnings this way, even if you can't yet figure out what the whether it's demand or supply, whether it's accumulation or distribution, you can create an option play in here. What do they call them? Straddles or strangles? I forget which, but doesn't really matter which direction it goes as long as it goes into a direction. Straddles. So you can do something like that. You can see how powerful this can be for you. All right. You can get a sense of how to price those straddles by this kind of analysis. Is hypodermic up move always reverse very quickly? Yes, it is, always. So where does point and figure say Apple is going? I didn't do that analysis yet, but there's larger counts. I think there's other counts up. We can look at that next time. So anyway, that's my that's what I wanted to cover tonight. So we've seen that point and figure charts help us understand supply and demand, that support and resistance becomes really, really clear, that these counts can be uncannily accurate, that conservative is always best. It's always going to be our friend in this when we're using point and figure charts. And when we're wrong, we can often get out gracefully. Unless we just totally are ignoring everything and just taking kind of wacky trades. I'm not talking that, but I'm talking about trades that you're using the point and figure chart to make and they turn out not to be correct. You usually can get out at a scratch or a small loss. Even though this thing is over 150 years old, you can see the value in it. It's really, I consider it a very valuable tool in the trader's toolkit. So let's see some other questions. How do you plot smaller time frames such as 5 or 15 minutes? Same way. No different. Go to your software and try 15-minute chart of the S&Ps on a 1 to 1 point figure chart basis. You'll see that. If you want to tie it into the way we use the Weiss wave, you do a 3/4 point instead of 1 point. And you will start to see that the Weiss wave is really a point and figure chart in disguise. Okay. If we use time-based time frames like 15, 60 minute, would we have different point and figure charts then? Yeah, because you're using a little bit different time frame. That's right. Not if you're it's not so much the time frame that matters, it's the box size, if you will. All right. So if we were tracking the S&Ps, for example, I would, maybe be using, on a swing trading basis, use a 5-point or a 15-point chart. And even if I use 60-minute or 15-minute charts, I'm going to get basically the same. I'm going to get, a 5-point figure chart or a 15-point figure chart. If I use a 1-point figure chart, I'm going to get a 1-point figure chart. It's the box size that determines the figure chart, not the time frame. When you are but time frame factors into it in the sense that when you're trading if you're trading intraday off of a 5-minute chart, that's your time frame, then you're not going to use a 15-point figure chart, because 15 points is a fairly average day in the S&Ps. That's the range of the day in the S&Ps. You've got to go to a smaller box size, if you will, smaller point and figure chart. Okay. How can you use them to differentiate accumulation and distribution? I think, Richard, we've been going through that kind of all session here. We differentiate accumulation and distribution on the point and figure charts by looking at the background, the Wyckoff story, and making logical assessments from there. Accounts seem highly subjective, that account can be found to support any move after the fact. What am I missing? You're missing the background. Gosh, I don't know how to explain this any more clearly. You cannot focus on the count. That's not the point. You have to focus on what the market is doing. You've got to be able to read that. If it's holding support, you want to be thinking about going long. In any spot of support, I can show you a down count, and a sizable one, I'm sure. I can probably find that. But those are not going to be what I'm going to be looking at. I'm going to be looking at up counts. I'm going to be looking at bullishness, because I'm looking at things like shortening of the thrust, changes of behavior, larger moves up than down, swift moves up versus swift moves down, choppy moves showing that there's not supply, support holding, markups, higher highs, higher lows. All of those things factor into it. We don't just make up counts and then say, well, which is it? Let me flip a coin. That's not going to get you anywhere. If you want to be a trader, you need to learn how to read the market by these, as I say, these multiple points of information to build yourself a story. If you just go in there blind, you go in there naked with no pants on and say, oh, there's a count, I'm going to take it, I guarantee you, you're going to lose your pants. You're not going to be able to, you won't have anything to wear. I don't know how much more clearly I can make that. They're subjective when you approach the market as a subjective enterprise. When you start to look at the market more objectively by its own actions and understand what it's doing and how it's moving, and whether demand or supply, buyers or sellers are more dominant, then it becomes objective. And then you use the point and figure charts in an objective way. When will the recording be available? A few days, I'm sure. At the next session, could we see examples in a lower time frame? Yeah, I don't want to spend too much time on that because it doesn't really matter. And I put a lot of effort into this, and I don't want to you focus on the principles, not the time frames here. Would you care to say a little bit more about a bit of the chap you will talk about in the next session. Bob Evans. Yeah, Bob Evans was the he took over Wyckoff Associates. He studied under Wyckoff himself. Wyckoff died at an early age. Bob Evans was a young trader at the time. He embraced the Wyckoff method like nobody's business. He began in the 1940s to make recordings every week on stocks of interest. And he would send those, he'd actually send the tape recorder, because back in the 1940s there weren't, it was a reel-to-reel tape recorder, but people couldn't afford them. They were very expensive. And so he would have a list of maybe 10 people, and he'd send the tape recorder around with the tapes. It was so funny. And then people got tape recorders, and he'd just send around the tapes. But he did that every week from 1940 something, early 1940s to the mid 1960s, maybe even into the maybe late 60s. I don't know, but some 20 some odd years, and I've listened to most of those tapes over the years. He was quite a great trader and one heck of a great educator. Must say he was. I wish I had known him. I mean, there are a few people in my life that I regret never having known, and he certainly was one. Had he still been alive when I started trading, I would have given my eye teeth to have worked with him. That's how much esteem I hold that fellow in. Okay, besides a 1.1 box, what other sizes do you use? It depends on the market. Sometimes you'll see in the Wyckoff literature 1x3, 3-point figure charts and 5-point figure charts. I never found the larger ones all that helpful for stocks, unless I'm trading like Google or PCLN, something like that. That's a high price stock. Then you need to use a larger box size, and you certainly do for the swings and the S&Ps. Do you want point and figure to mirror the bar chart? No, I want it to tell me information that the bar chart doesn't tell me. And we've gone through all of that tonight in this Apple. So listen to this a couple of times. You'll begin to see it. And also next week we'll start to pull this stuff together a little bit better for you. Victor says, makes sense you only care about the count after a story has told you the potential direction. Yeah, it's like analogous to coming in and looking at the right edge of the chart and seeing a dancing crow candlestick pattern and saying I'm going to go long or short based on that candle. And it's just, that's, people do it. They do it all the time. But it kills their account. Or they read about, a trade in a textbook on trading, and they see it set up, and that's all they're looking at is the indicator reaches a certain level, then I'm going to buy or sell, whatever the case may be, and that's what they do, and they get their hat handed to them. It's never about those trades set up. It's always about the background of the market. If you understand the background of the market, what the structure is in the market, you can apply any methodology, any indicator or any trade setup, as long as it's working within that market structure, you should be able to do well. So yeah, the story is really important. Your effort is very apparent. I've tried some time to learn this. You've added a lot. Good. I'm glad to hear that. Wow. Are those tapes still available? Yeah, probably on the Wyckoff SMI site, the Stock Market Institute. This was useful. I like the case study approach, says Ted. And I love the integration of point and figure with reading the market. Also, thank you for emphasizing and re-emphasizing that background trumps all. Absolutely. One of these days, I might write a book. I don't know. It was a pain in the neck to write the other one. But if I did, that's the first chapter that I would start with. In fact, David does in his book. Look at David Weiss's book, Trades About to Happen, and see where he starts. He starts with trend lines. That's the structure of the market that tells you the background. All right. Okay. Good. All right, everybody. I think that's it. If you have questions, send them to me by Sunday noontime, no later. And if you got questions about a chart, geez, attach the chart. Don't make me go create the charts to try to figure out what you're talking about. But I'm happy to, we'll spend a section next time, and figure it's going to be 3 hours like this. We'll spend a section on questions next time that you send in. Okay? All right, everybody. Have a great week, and have a good weekend when it comes up, and I'll see you next Tuesday. Thanks a lot. Take care now, and bye-bye.